Hi and welcome to the Buy-to-Let Mortgage Update for January. My name is Richard Purnell from The Mortgage Home. We are your buy-to-let mortgage experts. Before I get into this month's content, really briefly, thank you so much for taking the time out to watch this video. If you want to be updated for future videos, anything that we put out there on YouTube, etc., just hit the subscribe button. It's somewhere loitering around this video. And equally, listen, give me your feedback. Put some comments on there. Let me know if the videos are too long, if the content's not quite what you're looking for. I'm really keen to make sure that I'm putting stuff out there that you guys are going to find of interest. Okay, let's get into what's been catching my eye this month. Well, it almost feels like old news right now that the Bank of England rate increased up to 0.25% back in December. Well predicted. Not a huge surprise. And lenders are already responding, of course, by writing out to anybody that's on standard variable rate to tell them that their mortgage payments are going up. But what can you expect for the rest of 2022? Well, of course, we need a crystal ball for that, and it's just a personal opinion. But I would certainly say that you should be planning on a further 0.75% increase, possibly 2 or 3 lots of 0.25 over 2022. So I think it's a really useful exercise if you look at your portfolio and increase those rates by another 0.75%. See what does that do to your return? How are your rents looking when in context to slightly increased mortgage payments? So, are you charging the right rates? Maybe you could be slightly increasing the rates to offset that extra increase in mortgage costs. Equally, you can also be talking to your broker about what fixed rates are out there. There's still some really low fixed rates. They are on the move. They are starting to slightly increase. But given what I've just said, that we expect rates to increase throughout 2022, there's still a great opportunity to lock into a great fixed deal now before mortgage rates increase a little bit too much. Okay, let's move on. Accord Mortgages, that's the brand name for the Yorkshire Building Society, lend on a national basis. They've been lending to via intermediaries for years and years. We know them really well. They've had 80% rates out for a while, but they've now decided to cut them by about 0.2%. So that's good news. We're looking at about 2.67%, which is a cracking rate at 80% loan to value. But remember, Accord, being a building society, they're quite cautious. They don't lend to limited companies, and there will be some restrictions if you're a sort of larger portfolio landlord. So be a little mindful of that. But given that thing, if it's a great rate, 2.67, 80%. Equally, while we're talking about high loan to value mortgages, Foundation of this month launched into the 85% market. That's something I've been watching fairly closely all last year. It's been pretty, what can I say? It's hardly moved as that market in terms of the new lenders coming into that sort of rarefied atmosphere at 85%. But finally, we've got some movement in that arena, and Foundation have thrown their hat into the ring. Now the rates, okay, you might say, wow, 4.79 to 4.99, that's the sort of margins we're looking at. So you've really got to want that 80%, 85% deal. And I guess if you don't have much in terms of deposit, you only got 15%, then and it still makes sense for you, then crack on. But there's a little caveat here, just more generally, that, and this also goes for the 80% deals that I've just mentioned with Accord. I mean, it seems to be now a slightly growing market, which does, on a positive note, suggest that lenders are feeling that property prices are going to be fairly, there's going to be no surprises and no downturn, otherwise they wouldn't be getting into this, of course. So they're of the belief that property prices are going to be pretty constant, or if not on the rise. So you could, there's some real positives to read into that. However, if you're a portfolio landlord, then not only have you got the lender dangling a carrot saying, "Ooh, take one of our 80 or 85% deals," on the flip side of that coin, they're going to be looking at your portfolio, and the vast majority of lenders have a rule that says that your overall portfolio cannot exceed 75% loan to value. So we've got this mismatch here, or mixed message, I guess, in terms of what seems sort of acceptable. So you want to be really mindful that if you are attracted to the 80 and 85% deals for, say, your next buy-to-let purchase, that's going to push your overall portfolio loan to value up. So where is it at? Have you reviewed your portfolio? What is that overall portfolio loan to value? And genuinely, if it's hitting 75%, then that can cause you an issue. You've got a lender saying, well, I want to offer you an 80 or 85% deal, but if your portfolio gets pushed over 75%, I'm going to decline you. So be really mindful of that. Okay, BM, which is short for Birmingham Midshires, they've been a supporter of you landlords for years and years. They're a great lender with some cracking rates. Now, but here's something, it's not new, but it's something that is really, as I've put on here, under the radar. And it might even be that a lot of brokers are not aware of this. So if you own a HMO, then you might want to take some notes here, because it might be something that's appropriate to you. Now, they're offering HMO rates, but there's going to be some caveats. Now, if you are eligible, so I'm going to come on to eligibility in a second. Birmingham Midshires are offering deals at 1.5%, 1.51 to be exact right now. I had a look this morning, that they're 2-year fixed, and at 2% for a 5-year fixed. Now, for a HMO, that is ridiculous. Everybody else that offers what I would call a genuine HMO mortgage, you're probably talking at best 3.25% to 4%. That is the typical rate for a HMO. And here I am saying Birmingham Midshires will offer 1.5% to 2% on a HMO. How can that be? Okay, well, here's the but. Here's the but. It's only up to 5 households, so you can't have more than 5 in the household. So if it's a sleep 6, sleep 7 or more, then this product isn't for you. But here's the other thing. All the tenants in there, so let's say you've got 5 individuals, they have to be on one tenancy agreement. So that's the challenge for you as a landlord. If you happen to have a HMO with 4 or 5 occupants, can you get them, or is it appropriate next time things are changing to put them on to one tenancy agreement? You know, if it's 5 individuals, highly impossible, but if it's 5 friends or students all coming in, can that potentially be put under one AST arrangement? And if so, Birmingham Midshires 1.5% to 2%, it's going to halve your interest rate, halve your costs, and of course that all feed through to your bottom line. So it's definitely worth a look at that one. Finally, on Market Watch, my last bullet point is that it's something that I get asked a lot, and generally speaking, it's something that as a broker we can't do. But I found one exception to the rules. So here's this particular scenario. If you're looking to purchase a property and the seller is offering a discount, and you've no relation to this seller, it's not a family, interfamily purchase or anything of that nature. You just happen to have negotiated a great discount from the individual selling. Let's say they're getting divorced. Let's say it's a landlord retiring. They want to get rid of the portfolio, and they don't want to sell it with vacant possession. Let's sell it with a tenant in situ. It could be someone's moving out of the country or moving around for jobs. There's 100 different reasons why a seller is motivated to sell to you at discount. You and I probably know that. But that discount up to now cannot be used as part of the deposit towards a purchase. It never has been. Lenders won't allow it. You've got to almost lock it in there as equity that you can't touch. But when it comes to a remortgage, perhaps in 2 years' time, that's when you can unlock that discount. But we've now come across a lender who is prepared to consider such a thing. So if you've got, let's say you want to buy it, the market value is 100 grand, you've agreed to buy it at 90,000, then that £10,000 of discount you've negotiated might be able to be used as deposit. Have you noticed I'm using possibly and mights and maybes? Yeah, I know. Look, I know you guys want certainty. I'd love to give you some 100% cast iron guarantee that this lender would accept that, but they're being a little hesitant. But I'm putting it on here because every other lender I know, it's a categoric no, you can't use it. And finally, we've got a lender saying, we might consider that. So the acid test is, come to us with your inquiry, tell us the background about that specific case, what the discount is, the reason for it. We'll put that in front of the lender and we'll get a heads up really quickly on whether it's something that they feel they've got appetite for. And if that means you can use that discount towards a deposit, I think that's a fantastic turn of events and a fantastic another type of product that you landlords can use and keep that cash in your pocket. So yeah, could be really useful for those guys that are buying and still have some sort of discount in there. Okay, again, it's a really common question that we get asked at the Mortgage Home, and a debate we quite often get into. And I hear two sort of scenarios really, that certainly landlords that have had properties for a long time, the question is that once the mortgage term gets to an end, what's the plan? Are you going to keep these properties into retirement, or is the plan to sell them? And I do keep coming across these scenarios where you as landlords almost feel like, well, surely I'm going to have to sell these properties. Now, this depends on whether, for one reason anyway, whether you're on an interest only or repayment mortgage. You see, if you're on a repayment mortgage, then once the mortgage is repaid, then clearly you've got that option to keep those properties right up to your deathbed and keep that income going. But in my experience, there's only about 5 to 10% of landlords that I come across that have a repayment mortgage on their buy-to-let. So by a country mile, the vast majority of you landlords out there have an interest-only mortgage. And therefore, when those mortgages come to the end of the term, the lender's asking for the money back. So from a landlord's point of view, in your head, you think, well, I have to sell the property to repay the capital back to the lender. But I want to challenge that view. If that is your view, and if you thought that was your plan for retirement, that you were going to almost have to sell the property to release all the equity, and you're going to say, okay, now I've got a lump sum for my retirement and I'll live off the lump sum. And okay, that is a strategy, you can absolutely do that, but I don't think that's the most effective way at all. And this is why. Well, because clearly the second you're going to sell, Her Majesty's Treasury are rubbing their hands because they're going to have a slice of that profit, aren't they? Capital gains tax. There's highly likely there's going to be some CGT to be paid the second you sell. There's also the transaction costs involved in selling those properties, and that clearly is going to eat into that lump sum. You've also lost your rental income now. Clearly, the second you're selling those properties, that rental income, that passive income that in theory was there forever and ever, has now disappeared. So you're left with a net lump sum after paying off your capital gains tax and those other expenses I've said. And therefore you're now living in retirement, and you know, hopefully you're into retirement for 20, 30, 40 years. How long is that lump sum going to last? If you divide whatever that lump sum is by, 40 years, what is that going to give you? So I don't think that's the most efficient way of working. What I'm going to suggest is that you consider taking those properties right through to your deathbed. And as I've put on this bullet point, never sell. Now, there are lots of landlords out there that took mortgages out in the past, back in the 90s and early 2000s, and they were taking mortgage terms out that married up with their retirement date. So the mortgages are due to end when you are 65, 70. And therefore in your head, you've sort of got that mentality that you can't go beyond that age. And you're almost linking it in the same way that a residential mortgage works, where absolutely with residential mortgages, they do have to be repaid by the time you get to retirement, but buy-to-let mortgages do not. And lenders in the last, I would say, 5 to 10 years have really cottoned onto this and have changed their rules where they allow you to keep your buy-to-let mortgage well into retirement. So, like I say, I'm having these conversations quite regularly with landlords, and it keeps surprising me that you guys are not quite aware of this. I want to get the message out there that you can keep a buy-to-let mortgage until you're 80, 90, 100. I think that the lenders that I've seen that will allow you to keep a buy-to-let mortgage on interest only the longest is up to about the age of 110. And well done you if you get to 110. You know, life expectancy for us guys is what, 80 to 85? So there are plenty of lenders out there that will in theory allow you to keep that mortgage well beyond that age. And therefore, you can keep your property portfolio probably to your deathbed. Now, here's the additional benefit if you do that. Unlike capital gains tax, when you sell the property, the calculation for capital gains tax ignores any mortgages you have at that point. So keeping it simple, if you're selling at 100 grand and you happen to have a £75,000 mortgage, that is ignored. They look at the original purchase price. They look at the value on sale, and essentially, in very simple terms, the difference between the two is charged at the CGT rate. Now, here's the thing with inheritance tax. It's quite an exception to the rule. So let me take that same scenario. If you take that property to your deathbed and it's worth £100,000 in your estate, and you have a £75,000 interest-only mortgage at that time, that mortgage is deducted off the value of the property, so that you're only paying inheritance tax, assuming you're eligible for inheritance tax, on the net difference, the £25,000. So why wouldn't you take your debt to your deathbed? It's in your interest to do so. So I've got to say, I'm not an accountant. You do need to take accountancy advice on this point. That's just my sort of view on that. But I think it's really interesting to think about taking those mortgages right into later life. And like I say, never sell, take them to your deathbed. I think it's a great conversation to have if you've not thought of that. Okay, let's move on. Another thing that comes across our desk, frankly, on a daily basis, is issues with your credit score. So I want to spend this next no more than 2 minutes on some of my top tips for how to improve your credit score so that you don't get into that embarrassing situation where your broker's ringing you up once the application's gone in and saying, I'm really sorry, but the lender's declined it because your credit score isn't strong enough. So here's some really quick wins you can do. The first thing I'm going to ask you, when did you last get your credit report? Have you ever had one? Have you ever looked at it? Do you know what's contained in it? And if any of the answers are no to that, listen, after this video, put an action point. Go out there and get your credit report, ideally from one of these two companies, Experian or Equifax. There are plenty of other providers out there, but I'm saying these two for a good reason, because the vast majority of lenders use those two credit reference agencies when they're assessing you to decide whether they want to approve you or not. So why don't you look at that exact same data? So that's why I'm saying that. You should be able to get it as a freebie. Both companies offer 30-day free reports if you've not had it before. And then you cancel your free trial within the 30 days once you've got your report. And by the way, look, use our service. If you want to get your report and send it to us, we'd be happy to have a look over, give you our feedback, give you some tips and tricks on how to improve it if indeed you can. So there's an offer open to anyone that wants to take advantage of that. Now, some things that I come across that you can do really quickly to improve it. One is online banking is fantastic, really convenient. If you have let's say, moved house and you have online banking, then you don't think anything's changed. But actually, behind the scenes, that the bank would still have your old address on their records. And therefore, your bank accounts, savings accounts are all linked to your old address. And that not only drops your score, but can be an issue for the underwriter with an application when they're looking at your credit report and they're seeing that some of your, because they treat your bank accounts as a form of credit, you know, there might be an overdraft on there, but even not, it forms part of your overall credit score. And if you haven't moved your bank account address to your latest, to where you're currently living, simply because you don't think about it, because you're on online banking, you don't get paper statements through the door anymore, which is the sort of the norm, I guess, then that's going to reduce your credit score. So make sure that your bank has your current address. Now, here's a real common one that I'm seeing. Pretty much most of us use credit cards on a regular basis. Obviously, there's a few people that don't, and I don't want to encourage you to get into credit card usage if you're not disciplined when it comes to using credit. But for those of us that use a credit card, it's a real double-edged sword here. So what I mean by that is, if you've got £1,000 credit card limit and quite regularly you're using 80% of that, you're up at £800 a month, £900 a month. Yes, you still might be paying it off, but you're utilizing the vast majority of your limit on a regular basis, or indeed carrying that balance forward month on month. Then that's going to score you down. Lenders do like to see you using credit. Yes, they want to get an idea that you are financially responsible and that you can pay that credit card off every month or make your payments on time, month in, month out, without being late or missing any payments. Absolutely. But if it appears, and it is perception, if it appears to the lender that you're using 70, 80, 90% of your limit every month, then that's a perception of the lender that you are almost living on some form of debt, and therefore it actually is going to score you down. The sweet spot when you're using credit card is around 50% or slightly less. So whether you carry that balance forward or you're paying it off every month, but don't, if you can, stick around 50% or under of your credit card limit. A little tip, if you want, you might want to, if you are using 70 or 80% of your credit limit every month, these providers might actually up your credit limit quite easily. So if it might be something to look at, that you ask to have your credit limit up to £1,500. So you're still only using £700 or £800 of that credit limit every month, but you're now all of a sudden at this 50% limit because they've increased the limit. Just bear in mind, if you do increase your limit in the short term, that also can have a little negative impact on your credit score. So it takes a few months to recover if you do have your credit limit increase. So, you know, be a little mindful of that. It's a lot more efficient if you can somehow just use slightly less of your credit limit. So that's the thing on credit cards. Now, notice of correction. You may or may not have heard of this. Let's say you check your credit report out and you see that there is in the past, because these reports hold up to 6 years of your financial credit history. So when you look at that historical data, and if you notice that there appears to be from a utility provider, for example, that it says on there that you had made some late payments on your gas or electric bill, let's say a year ago, and you actually challenge it, you think, well, that's not right. But rather than rolling your sleeves up and going back to that utility provider and arguing the point with their complaints department or whatever, and spending weeks on the phone to try and convince them and getting it overturned, sometimes these utility providers say, oh, well, if you put a note onto your credit report and explain what the circumstances were, then that will balance out the information that lenders would have. That yes, it might say in arrears, but that the applicant has put a notice on there explaining why. Now, that might be fine as far as speaking to the utilities companies concerned, but I'm telling you what, lenders ignore that completely. So it's a real red herring. Notice of corrections, in my opinion, as a mortgage broker, have very little to no use whatsoever. So if you think you've got a case that you weren't in arrears and you can argue and you have some evidence to show that you made that payment on time, then I'm afraid there isn't a shortcut. You roll your sleeves up, you get onto British Gas or your water company or whoever it happens to be, and you argue your point and you threaten, you use the word complaint if they don't sort it out, or indeed chuck that into the conversation quickly so that they can't fob you off. They've got to treat it as an official complaint and they have to deal with it and they have to put it right if you've got that evidence to say it was never in arrears, never late payment, or you didn't miss that payment. And then that will improve your credit score. Very last thing on here, then I'll move on. County court judgments. Clearly, they're like hand grenades. If you sadly are the recipient of a county court judgment, they have a very big impact on your credit score. They will drop your score hugely, and many lenders may well decline you outright, and it can have an impact, as I said, for up to 6 years. So even if you are in dispute with a provider that is threatening to put a county court judge on you, you've got to sometimes take a view on it, because if you lose that case, once that CCJ is registered against your file, then I'm going to come to an exception in a second, which is an interesting point. But generally speaking, they're going to be there for 6 years. It will have an adverse effect on your credit score and your ability to get mortgages and finance for that length of time. And you've got to sometimes take a pragmatic view on, is it worth paying that CCJ? Paying that bill so it doesn't get to a CCJ. And then you can still argue the point with that provider. You could pay it so it doesn't go to court and then still try and contest it that way. And then maybe if you win it, you get your money back. But if you let it go to a CCJ and you lose in the court, then it's pretty much game over. The only exception to this, there's a real short window of opportunity. So let's say that you ended up with a county court judgment. You have, and it's a little known fact here, and if you hear of any friends, people down the pub moaning that they just happen to have picked up a county court judgment, here's a little nugget. If you pay that county court judgment off within the first 28 days of it being registered against you, it is wiped off your credit report completely. Wiped off, Tipexed out, as if it never happened. It will have no impact on your credit score, but it has to be paid within 28 days. If you wait to day 29 and say, okay, I'll still pay that county court judgment off, but it's on day 29. Yes, it's paid off, but it's still on your report for 6 years. It will still have a negative effect for 6 years, even though you've paid it off. It stays there as a black mark on your report. So there is a short window of 28 days. So may not be relevant for that many people, but if it is, wow, that's gold dust. Finally, just a little point on insurances. We clearly talk to lots of our clients about insurance and putting this in place on a regular basis. But here's a question we ask all our clients. So ask yourself the question, have you stopped smoking in the last 12 months? You'll see why this is relevant in a second. Or have you got friends and family that are likely to have an insurance policy, a life insurance policy, that they took out when they were smokers? Now, here's the thing about life insurance providers. If you have quit smoking, and I do mean properly quit smoking, for 12 months, so you've not had patches, you've not vaping, you have quit smoking for a year, then insurance providers will assess you as if you are a non-smoker. So there's no middle ground. When underwriters are assessing you for an insurance application, it's really black and white. You either are a smoker, including patches and vapes, or you're a non-smoker, i.e. you have not smoked for 12 months. How do they know? Well, they may well get someone out and do there is a test they can do to see if there's any anything in your bloodstream that might suggest that you've been smoking. So there is a sort of way I think they can check it should they want to do. But the reason that I'm highlighting this is that the premiums for two individuals of the same age and the same health, and the only difference is one's a smoker, one's a non-smoker. For the same amount of cover, the premiums are about 50% cheaper. That's how much a smoker is penalised when it comes to taking out life insurance. So going back to my point, have someone stop smoking? So if they took life insurance out as a smoker, then the premiums are 50% higher. And if they have managed to stop for a year, it might be worth having that reassessed and taking out the same cover and saving 50% on your premiums. Remember, you're paying life insurance for 20 to 30 years. If you can save 50% of your premium for 20 to 30 years, you do the maths. Massive, massive savings. So that might be something that applies to you, but it could be what a gift if you can say to a family member, oh, you quit smoking, didn't you? You know, New Year's resolutions, whatever. And you think, yeah, you know, they're a homeowner, they've got kids. There's a good chance they've probably got life insurance, but someone quitting smoking was never likely to then link it back to an insurance policy. I think it's highly unlikely. So that's really a little tip. And if it's something you want us to look at, we do have our own insurance advisors. It's a free service. We don't charge for any advice, putting things in place. So by all means, get in touch. I'm going to mention this. Here we go at the end about how to just get in touch if you want us just to review that and say, well, how much could I save on my insurance premiums? Really briefly, here's just a flavour of the services we offer. So should any of you guys want to just have a further chat about any of those types of products, then we'd be delighted to give you our professional advice on that. And really, this is the last slide now. If anyone does want to get in touch, wants to have a chat about anything I've talked about today, or indeed any other aspect of being a buy-to-let landlord, whether it comes to mortgages or insurance, just click on that link. It'll take you through to the team's diary, and you can have that free review, have a chat, and you never know, it could save you a lot of money, and we'd be delighted to help. Other than that, thanks very much for watching to the end of this video. Hope you have a great month, and hopefully we'll see you on the February review.